So Baba stock, the stock of one of the biggest and most powerful e-commerce stores in the world, was able to perform a strong upwards trend of almost 250% in the last few years, but recently underwent a pullback from those all-time highs. So what we are going to do today is give you an updated insight into what is actually happening to the stock and break down exactly whether it is still a buy at the end of this video. As always, what we want to talk about in the next few minutes is absolutely crucial to know before even considering buying the stock, so stay tuned for that. Really quick before we jump right in, however, just make sure to hit that subscribe button down below. And as we'll keep you updated on breaking news and awesome trading opportunities every single day, subscribing would not only help us but also you. So there is really no excuse for not smashing the subscribe button. It's free, and you can always unsubscribe if you feel so. Alright, let's start talking about the stock, and as mentioned before, the company behind it is absolutely crazy. So we are basically looking at China's equivalent of Amazon, a huge platform for merchants and brands to reach millions of daily customers. So it's no wonder that the company, with its massive e-commerce and cloud infrastructure platforms, its ecosystem extending across the advertising, media, internet software and gaming markets, consistently generates double-digit revenue and earnings growth. Among investors, Alibaba is often considered a solid long-term investment on China's booming tech sector. Yet, and this is crucial to consider for our prediction at the end of this video, Alibaba has lost nearly a fifth of its market value over the past 6 months as regulators in China and the US have scrutinized its sprawling business. Rising bond yields, which sparked a rotation away from higher growth tech stocks toward value stocks, exacerbated that sell-off. So we have to talk about some massive challenges that will face Alibaba's stock in the future, especially as regulators tighten their grip on Alibaba. In early 2020, for example, China's State Administration for Market Regulation started expanding its antitrust laws, which had primarily targeted large foreign companies, to also monitor its domestic companies. Then in late 2020, China forced Alibaba's fintech affiliate Ant Group to suspend its IPO, fined Alibaba over unapproved acquisitions, and launched a formal antitrust probe into Alibaba's e-commerce business. China's government will reportedly force Alibaba to halt its exclusive deals with merchants and its usage of promotion prices to attract new customers. But as said before, it doesn't stop here. It could also pressure Alibaba to divest some of its media assets to curb its online influence, share all of its user data with a state-backed joint venture, and distance itself from its outspoken co-founder and former CEO Jack Ma, who sparked the suspension of Ant's IPO by publicly criticizing China's state-backed banks. New provisions from the Chinese Communist Party, which were introduced last year, will also require domestic companies to hire a certain number of registered party members to monitor their business practices. To top it all off, the State Administration for Market Regulation could levy a one-time fine against Alibaba, which will likely surpass its record $975 million fine against Qualcomm back in 2015. All those new rules could then of course throttle the growth of Alibaba's core commerce business, which generates most of its revenue and all of its profits. They could also erode its defenses against its main e-commerce rivals, while weakening its ecosystem barriers against other Chinese tech giants like Tencent and Baidu. So Alibaba's antitrust challenges in China are dominating the financial news cycle, but it also faces 3 unpredictable regulatory issues in the United States we quickly have to talk about before we can come to a prediction at the end. First, a new US law, which mainly targets US-listed Chinese companies, will require all foreign companies to comply with tighter auditing rules and prove they aren't controlled by a foreign government. If they don't comply for 3 straight years, their US-listed stocks could be delisted. But as the Chinese government tightens their grip on Alibaba, it could become impossible to comply with those new demands in the US. That's why Alibaba launched a secondary listing in Hong Kong in late 2019, and why American investors should be wary of holding its ADR shares. Second, Alibaba's Taobao has been repeatedly placed on the US Trade Representative's blacklist of notorious marketplaces for its alleged sales of counterfeit goods. Pinduoduo has also been included on that blacklist, while JD.com, which operates a first-party marketplace instead of relying on third-party sellers like its 2 main rivals, has not. And lastly, the Chinese government uses Alibaba's facial recognition, cloud, and AI technologies for various surveillance purposes. That controversial relationship, along with its other aforementioned issues, could make Alibaba a ripe target for US sanctions. But considering the extremely solid growth in the past, it still is very likely for the stock to rebound. So what we recommend doing is to wait for a confirmation of another uptrend and then take the highs of the stock as a target while setting your stop loss right below the point of rebound. Alright, with that being it for today's video, however, thank you very much for watching. If you like this video and want to support our mission of providing free financial information to everyone here on YouTube, please ensure you're subscribed and definitely consider leaving a like. As mentioned before, it really means the world to us. Thanks a lot and see you next.